Hi there, this is Chris Sparrow from Liquid Metrics. Have you ever wondered why your order price deviated from the VWAP benchmark? If so, stay tuned here. I've got a short presentation describing a tool that we've built at Liquid Metrics which will attribute your performance versus a VWAP benchmark. So let's take a look at the tool. The first thing to look at here is this price volume distribution. What we're plotting is the fraction of market volume that occurs at each price during the lifetime of our order. Okay, in this case, our order was about 5.5 hours, so we take all of the volume that occurred in the market across all the trading venues, and we add it up and group it by price. Okay, this distribution is really the opportunity set that you would have had as a trader when you interacted with the market. This is real executed volume that occurred. So what we can also do with this distribution is we can compute the volume weighted average, and if we do that, we can fit a Gaussian to the market price volume distribution, and the peak of that Gaussian is going to be the volume weighted average price, which is our benchmark. The width of this normal curve can be characterized by the standard deviation, and we can interpret that standard deviation as the intra-order volatility. So if we can imagine for a moment that all of the volume occurred at a single price, the width of a fitted Gaussian, or the standard deviation of that distribution, would be 0. The intra-order volatility would then be 0 as well. There are no price changes, and it would be impossible not to match the volume weighted average price with our order's average price. As more volume occurs at different prices, it becomes more difficult to match the VWAP order, which means that we can interpret the intra-order volatility as a difficulty factor that we can normalize by in order to handicap this particular order. Now, the reason we would want to do that is we may want to aggregate performance across many different stocks. Each of the stocks might have a different intra-order volatility. Okay, so what else can we do with this chart? We can take our order volume and we can map that out as a function of price. So now we're comparing what fraction of the market volume occurred at each price and what fraction of our orders volume occurred at each price. And we can see certain prices, like here at 1258, where for our order we traded a relatively larger amount than occurred in the market, which would be a good thing because we're a buyer here and we want to buy more volume below our benchmark than above our benchmark. So these prices, 1257, 1256, we did a good job there. But at these higher prices, 1264 for example, we also traded more volume at a higher price than the average, and that's going to bring down our performance. Okay, so looking at the differences between the blue bars and the black bars here, we can see which prices did we trade not enough volume or too much volume as compared to the total volume that traded in the market at the same time that we were working our order. Okay, so there's something else we can do with this distribution. If we look at our order size, so here we have an order of 12,500 shares, and we move from left to right, using up all the volume in the market until we get to a total volume of 12,500 shares, we can compute the average price, and that would be the lowest average price that could have been achieved given this opportunity set here of transacted liquidity for an order size the same size as ours, or 12,500 shares. That price we've got over here on this chart, on this gauge, and we can compute that it's 12.4866. We can come the other way and figure out what's the highest price that we could have achieved in the market given this volume distribution, and that's this point on the gauge, 12.7445. The green part of the gauge is going to be the volume weighted average price plus or minus 1 standard deviation. Okay, so if I put on the Gaussian again, 1 standard deviation is going to be about that distance here, and we can use that to color our gauge. The red needle, that's going to be the VWAP benchmark, and the blue needle is our average price. So the VWAP, we can see 12.6351, and our average price 12.6294. Okay, so now we've got a way of being able to tell whether our execution was good or bad. Are we within the green here or are we not? We also have a way that we can now aggregate performance across instruments that have very different volatility characteristics. We can simply report performance in units of standard deviation or intraday volatility. Okay, so let's move down to this chart below. And what we're doing on this chart is we're plotting the fraction of volume on the y-axis on the left. On the right, we're computing the average price. And then our x-axis is really a time axis. This is time during which the order was executed. So this is in GMT. This would be 10 a.m. Eastern Time, trading up until 3:30. So here what we can see, if I just turn off the order information, how much volume occurred within each 30-minute price bin in the market. And then above that, with the line chart, we can see what was the average price of all of that particular volume. Now the volume weighted average price is simply the dot product of these two time series. So we take the volume times the price that occurred in that bin, and we sum over all of the points that we have here, and that's going to give us our volume weighted average price. In a completely analogous way, we can look at what happened with our order. Our order's average price will be the dot product of these two time series, and we can see how much volume occurred at each 30-minute bin during which the order was being worked, and what was the average price that we got for our order within each of those bins. So a question that may come up: how much of the underperformance or the overperformance, really the performance deviation, occurred because our order volume did not match the market volume? Okay, so here we can see that with our order we traded a little bit more at the beginning, the first half hour, second half hour we trade a little bit less, etc. And we can see how that progresses throughout the life of the order. Well, we can compute what the average price would have been if we matched the market volume identically, but within each of the bins we take the average price that we achieved in the market. If we take the dot product of these two time series, we're going to get a number over here, 12.6318, which represents the average price that we would have gotten if our volume distribution versus time matched exactly the market volume distribution versus time. Now, of course, we can do something very similar where we'll take our order volume and we'll take the market average price within each half hour, and we can compute this number here, and that's going to show us what our average price would have been if we matched the trading results, if we matched VWAP in each of these half-hour bins. So now we can see the sensitivity of our performance to the volume distribution as well as to the prices that we achieved within that distribution over time. So what this all does is allows us to attribute our performance for VWAP deviations, and it also provides us a way where we can aggregate orders across securities that have very different liquidity characteristics, especially volatility. So in closing, I just want to review, we've built a tool We can look at what the VWAP deviation is for each of your orders, and we can explain why you had that deviation. Thank you very much.